Welcome back. You're watching HFO-TV. HFO-TV is co-sponsored by J.R. Johnson LLC, specialists in multifamily restoration and repair work. Gantry Incorporated, the nation's largest independent mortgage banking firm. Butler Exchange Group, offering 1031 tax-free exchange services. And Forensic Building Consultants, experts in the diagnosis, repair, and preservation of multifamily assets.
Well, it's going to be a very interesting race this year. We'll see how it all shakes out in Portland City Council. I'm now going to give an update on what we saw in the brokerage community on the market for multifamily. As we've talked about before, permits have been very interesting. We saw a big run-up in building permits in 2017 because of inclusionary zoning. We've seen, as we predicted a couple years ago, that we would see a decrease in permits once the pre-inclusionary zoning units came online, and that's what we've seen. So again, as we've seen through the last couple of years, permits are down, not historic lows, but below where we were, and definitely not keeping up with demand. The interesting thing on building permits in permitted properties that we're seeing more, not just centralized in the core. We've seen Clark County take a big percentage. Again, there is a lot of close in west side, close in southeast, but it's interesting seeing some new construction now going to some outlying areas. One of the things with new construction is the cost. Even with the decrease in the number of units being built, the cost to build these has not gone down from supply chain issues, labor costs, materials. So as again, in tertiary markets, it's sometimes tougher to get units built because the rent levels aren't there, even with the increase in rents that we've seen. But again, it's been encouraging to see just not the downtown core being the beneficiary of some of the new construction. But the overall theme is, yes, we still have some being built, but it's not enough as we predicted before. And so therefore we're seeing upward pressure on rents and vacancies. In terms of vacancies, depending on what publication you look at, we've seen a decrease in vacancies. Concessions were, at the beginning of 20, were readily available with the absorption of these new units. That has slowly gone away, and we've seen vacancies decrease even with the pandemic in place. What's that done with the lack of construction, decrease in vacancies is rents. We've seen rents increase across the market. Depending on what publication you look at, we've seen numbers anywhere from 6% up to 13% year-over-year increases on rents. I will say it's sometimes tough to get actual numbers. Some take into concessions, some do not. But the overall picture is the rental market's been very strong with the increased demand. We still have the in-migration coming into the region. You've got less units being built, and so therefore you've got bent-up demand in terms of absorption, and it's causing an increase in rents and lower vacancy rates. The interesting thing is on transaction volume. 2021 will go down as the biggest year for apartment transactions in terms of volume, number of transactions, and dollar volume. We crossed over $3 billion in the volume, which we've never seen before. And in the number of transactions, we also hit a high both in private client and in institutional side. If you would have asked me this back 18 months ago in March of 2020, I thought we would have seen a little bit of a lull. We did not. We came right out of, from the COVID pandemic starting in about June and has not stopped at all through 21. There's a couple things fueling that. One has been the low interest rates, which have kept investors interested in the product type. The other is the lack of concessions, the barriers of entering the market, and the continued rent growth. When you couple all those together, you've seen increased demand in the Northwest in terms of a place where people want to put their capital dollars. Even with the political environment, the uncertainty with COVID, things of that nature, we've still seen investment dollars getting out of other product types from retail and office, looking for allocation of multifamily. It has driven demand beyond our expectation. We've seen downward pressure in cap rates. So again, I think we'll look back in 2021 and say that this was maybe the high watermark in terms of volume from transactions and the dollar amount. In terms of the political environment, which we just talked about, there was a number of legislative bills in terms of housing that came across in 2021. As you can go to our website to get more information. Example of a few are the extension of the moratorium, where there was a special session in December of 2021 where they passed an added extension, but also doing some additional funding. I guess the good thing from what we're hearing is Oregon did an okay job in getting funds out, better than what we've seen in California and Washington, but still not good enough to help the tenants that are out there. So again, we're hoping maybe the political winds change a little bit and we get a little bit more balanced from a political standpoint. Because again, as we've all known, the last 5 years have been an upward battle in trying to get from city of Portland to Salem to Olympia and Seattle kind of understanding the dilemma that they're putting housing providers in. We hear these cries all the time, and again, we're trying to educate and educate. It's been a tough road to hoe, but again, hopefully maybe there's some political winds of change. When we get a little bit more balance, I don't think it'll ever be the way it was back, in the 80s and 90s, but it's been so tilted to one way, it just doesn't seem like it's been fair. And the amount of the burden that's been placed on apartment owners and housing providers during this pandemic has been unprecedented in terms of industry and getting assistance. So the good thing is they're allocating money. Hopefully they're better in getting it out to people in need, but that's kind of wait to be seen, but we'll keep our fingers crossed. In terms of market predictions for 2022, we feel transactions are probably going to be flat, if maybe slightly down. Yes, it was a record. I don't know if we're going to top that, but it's going to be close. We don't see any winds that may change it other than interest rates. And I think because of the potential of interest rates going up, you're going to see maybe a lot of demand and things trying to get settled in first quarter. So that's going to be very interesting to watch. Permits and vacancy, we think, are going to probably go down. I don't see the cost of construction, the barriers of entry are not. It's not easier to build in this market anymore. So because of that, I think you're going to see permits flat to down, and vacancies the same thing. We still have immigration to the area, though it's not as robust as it was before. We still do have people moving here, and they need housing, and we're just not capable at this point to build enough housing to house that. So that's going to drive vacancies down. Employment and interest rates, we feel, are probably going to go up. I mean, I think employment rates are going to go up. As we know, everybody's heard about the shortage from supply chain shortages, but also from employee shortages. So, hopefully that kind of works through itself. And again, the Fed did come out and say they look at doing some interest rate hikes to offset inflation. We think that's going to happen. The question will be, do cap rates, coincide with that, or do we still see some downward pressure on cap rates, or at least keeping flat? Kind of the overriding theme in the last year has been the continued inflow of capital into this marketplace for multifamily. From capital that was allocated towards office, retail, multifamily, and industrial, and two kind of commercial real estate areas where we've seen an increase in capital and more demand. That's driven cap rates down, valuations are up, and we don't think that's going to change in the short term. Housing we know is going to be short. I mean, we hope on the political side things get a little easier to deal with and navigate. But overall, just the amount of allocation for capital to get in these kind of investments. Commercial real estate is no longer looked at as an alternative investment. I think that was the kind of an underestimation on, coming out of 2008 and 2009 was the amount of capital looking for alternative investments. Commercial real estate was one, and multifamily has been the darling of that for the last 10 years. And we see that to continue in this marketplace. The other interesting thing will be how much capital again, has gone into tertiary markets that 3 or 4 years ago they wouldn't even look at it. Now they are. So the whole state is getting some of the benefit from Bend to Medford, up and down the I-5 corridor, up to Olympia. Everywhere is kind of benefiting from this increase in demand for multifamily. So for 2022, we think we'll see continued demand throughout the marketplace, even with the potential increase in interest rates.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.